In Forex trading, we all watch economic data releases, GDP, employment, inflation, retail sales. But here's what most traders overlook: the revisions that come afterward. And believe it or not, sometimes those revisions move the market more than the original release. Let's break down why economic data revisions matter so much to traders. When major economic indicators are released, they're often labeled as preliminary, advance, or estimate. That means the numbers are based on partial data. The government or agency releases them quickly to give the market an early picture. Later, when more complete information becomes available, those numbers get revised. And here's the key: those revisions can completely change how traders interpret the strength or weakness of an economy. Let's say the US posts a GDP growth rate of 2.0%. The market reacts, and the dollar strengthens because it looks like solid growth. But a month later, the figure is revised down to 1.2%. That revision tells traders that the economy wasn't as strong as initially thought, and the dollar could weaken as expectations for interest rate hikes cool off. In short, revisions can flip the narrative after the initial excitement fades. Now the same applies to employment data, inflation, and manufacturing numbers. For example, the famous non-farm payroll, NFP report often gets revised in the next release. If the previous month's job gains are revised sharply lower, it can completely change how markets view labor market strength, even if the current month's data looks good on the surface. This is why experienced traders always look beyond the headline. They don't just react to the new number. They also compare it to the revised data from previous months. That's how they measure real momentum, not just short-term noise. So, how do you use this in your trading plan? Step 1. Track revisions over time. If revisions consistently trend upward, it means data is improving and the economy is stronger than first reported, a bullish signal for that currency. If revisions are consistently downward, it suggests hidden weakness, a bearish sign that might influence central bank decisions. Step 2. Watch how central banks interpret revisions. Institutions like the Fed or ECB pay close attention to revised data when making policy calls. A series of upward revisions to inflation or jobs data could push them toward tightening policy sooner, while downward revisions could delay it, and that shift directly impacts currency strength. Step 3. Be patient with market reactions. Sometimes the first move after a data release is emotional, but revisions can quietly reshape sentiment in the days that follow. This gives swing and position traders a powerful opportunity to trade on refined information, while others chase the headlines. To summarize, initial data grabs attention, but revisions reveal the truth. Revisions can confirm or contradict the market's earlier reaction, and smart traders use that insight to anticipate shifts in economic perception. In Forex, the first number moves the crowd, but the revision moves the professionals. If you want to trade with deeper insight, don't just read the headlines. Read the fine print that follows.